Hello, and welcome to FCLT Global's Risk Webinar Series. Thank you for joining us for the fourth episode of this series. Today, we are here to discuss climate from uncertainty to risk. I'm so excited by the panel that we have today. I'd like to introduce, we have Deborah Ng from Ontario Teachers Pension Plan, where she is head of responsible investing. We have Kim Chong from the Hong Kong Monetary Authority, where he is head of risk management and compliance. And we have Chris Gulgazian from Wellington, where he is director of climate research. These are the right people to have on this panel because they are purposeful on this issue. They are in fact moving money in long-term directions through the way that they manage climate risk. Moving money in long-term directions is, of course, the reason why FCLT Global exists. And so I expect that we're going to have a very productive and insightful conversation today. We host these webinars on the basis of content that we have prepared over the past several years. The foundation is a publication called Balancing Act, Managing Risk for Multiple Time Horizons. We've also spoken about how to integrate long-term risk management practices into the owner-manager contract agreement in a publication called Institutional Investment Mandates, Anchors for Long-Term Performance. And we are also applying this concept of long-term risk management to climate in a series of events, of which today is the third. We previously touched on this subject in our 2019 Forum on Risk and at our 2020 Summit. There are summaries of both of those events available on our webpage as well. As always, Bryn Costello is our producer for this series. Her email address is bryn.costello@fcltglobal.org. If you have any technical issues with the Zoom platform today, please send Bryn an email. Also, Bryn will be aggregating questions and passing them to me so that we can introduce them into our conversation with Chris, Deborah, and Kim along the way. If you prefer, you may also add those questions into the chat function of Zoom. This session is recorded so that we can archive it on our website for investors who may be in time zones that can't join today, and also in the spirit of continuing professional education for investment risk managers generally. It is exactly an hour long and promptly at 9:30 Eastern Time. With that, I'm excited to get the conversation kicked off. And I'd like to do it by asking a question that goes directly to our title for this event. Here's the question. Is climate change a risk, an uncertainty, a trend, some combination of those things? And why do those distinctions matter? Chris, I might go to you first to get the conversation started, and we'll go from there.
Sure, Matt. Nice to be here. Hi, Deborah. Hi, Kim. Nice to see you guys. So I think our view is that it is a risk and a secular trend. So two of the three, far less of an uncertainty. And as a risk, we view it as a risk to capital markets. And our job as fiduciaries is to assess all risks on behalf of our clients. So we should have a view on this risk as well. And then as a trend, a secular trend, the work that we've done with Woodwell Climate Research Center, formerly Woods Hole, has shown us that the next 3 decades get progressively worse. They are largely inalterable. I think most people would say 30 years is secular. It's probably going to be worse even beyond that, of course. But let's just talk in terms of a 30-year mortgage bond or a 30-year maturity. That's secular. And the projections are getting worse on a secular basis. Uncertainty implies that there's still a chance that this doesn't happen. Our work with the scientists would show us the likelihood of that is very low. The only uncertainty is really the timing of events. It's very hard to tell when a hurricane or a wildfire or some type of drought may happen, but the trend change that they are going to happen in increasing numbers is very certain.
I appreciate it, Chris. Kim, I'm curious if you see things similarly from where you sit in Hong Kong.
Yeah, definitely. We see climate risk, being a risk, high uncertainty, although it's a slow burn, and certainly the trend is certainly catching on in this part of the world. Climate change impacts financial performance of companies, and therefore it impacts the risk return profile of the securities that they issue. We all know about the transition risk and fiscal risk and so forth. I won't go into that, but just want to quote something from the UNPRI from their recent study, the Inevitable Policy Response, saying that the financial market really has to prepare for the climate change policy, saying that if you don't do anything by 2025, and that's the crucial date, the change will be abrupt, be forceful and disorderly because of delay. But I think the report actually says that these sort of risks are manageable as a sort of silver lining. They try to come up with some figures saying that according to this report, the Inevitable Policy Response, the iShares, MSCI All World will fall non-cyclical by about 3.1%, or they quote a figure of 1.6 trillion. So, I mean, the key policies are, the coal phase out. A lot of countries are moving by 2030, like EU, Canada, Chile. I think we are sort of in this part of the world, we are watching all those developments. You have the internal combustion engine sales ban, 2035 in EU, and Asia is following suit. So there are a lot of trends happening, and with obviously the more advanced ones, Paris, Madrid, Amsterdam has already announced bans on diesel or the internal combustion engine by 2025 or 2030. So all these are trends coming through. So we have uncertainty, we have trends, and certainly it's a big risk.
I appreciate it so much. Deborah, I'm going to ask that you help us bring it into some applied context. We've heard the themes of timing and measurability. We've heard the distinction between transition and physical. And Chris also alluded to the partnership with Woodwell, which I know that Ontario's transition plan is part of as well. Could you share a little bit about what that partnership looks like, what it's like to work with true climate experts on this issue, and anything that you've learned about the issue of timing, measurability, and the distinction between physical and transition from that?
Sure. It's actually perfect because when you threw that question out, I really thought, okay, if we were to take it right down to sort of grassroots and how that impacts our work every day and make it more tangible, climate change obviously is all three: a risk, uncertainty, and a trend, right? And physical impacts to us are a risk, right? And I'm going to be very technical here. The potential outcomes and their likelihood is something that can be known. And this is based on science. And this is also based on the work that we have been doing with Woodwell and Wellington on getting better information, better data, so that we can better figure out what the potential damages are and what their likelihood is. When we think about transition risk, that's, I think, is an uncertainty, to some extent, or at least it was in the past, because it's really behavioral, right? It really depends on how society, how governments and companies and consumers act in reaction to climate change. And then from the trend side, I think the trend helps to inform some of that uncertainty. And we see that we are transitioning to a low carbon economy. Kim talked about the trends that were going on around the world and the commitments that are being made. And this really helps give better credence that the transition risk is becoming more and more of a likelihood, or a measurable likelihood, as opposed to an uncertainty. And if I were to think about maybe some of the work and how that could have implications for our pension plan, I can give you an example. We had an investment in a container terminal The asset's located in a region that is vulnerable to flooding. As well, as a container terminal, a significant amount of its revenues came from the storage of oil. So on the physical side, based on science and work from Woodwell, you could assess the likely frequency and severity of flooding, and we can get a reasonable estimate of the cost to the asset from business disruptions, as well as maybe costs for remediation and repairs. And then obviously compare that against your future cash flows, and you can make a decision on mitigation and adaptation CapEx for the company. This contrasts a bit more with the uncertainty on transition and the possibility that, if you're a container terminal that is reliant on, storing oil, could this asset actually become stranded much quicker than you thought if the demand for oil were to drop precipitously, or we have a long period where the demand for fossil fuel persists? There's a bit of uncertainty as to, how that plays out. So I think, this is one way of how you kind of have to, consider both the physical risk, but as well as the transition risk when you're thinking about your investment decisions.
Sure. Thank you for that. There's a lot going on. It's a very multidimensional, complex challenge. This is, of course, a webinar on investment risk management. Kim, I'm going to go to you with a question next about how we bring it into that investment risk management practice. What shortcomings do the usual risk statistics have when it comes to long-term phenomenon like climate change?
Well, in terms of statistics, I think we all know that things are still evolving. Stats are still developing. The best source and the most accurate are the insurers. If you go and ask them for a price, they need to price them properly. Otherwise, they could go bankrupt overnight. Certain parts of Florida and other parts of you can't get home insurance because the pricing and stats are against them. So I think we face a multitude of risks across our business, and potentially as Deborah said, it affects revenues, it affects physical buildings, assets, and so forth. So it's not just a figure that you can pull out of the hat. There are a lot of soft observations. As you say, it's the uncertainty is so high. You're never gonna predict when the next severe kind of storm, next severe kind of weather, and so forth gonna arrive. So it's very, very difficult to place a number on risk statistics, such as volatility, Sharpe ratio that we all so well aware of and so used to in our daily investment analysis work. So I think it's difficult to say. It's hard to say it's exact science. It's more difficult than that. It's more art, but for some, as I said earlier, that you need figures to help you price risk properly, where it's so acute that your business relies on it. For us, I think we take it more on the soft edges. We look at physical risks. We look at the kind of stranded assets, as Deborah mentioned. We see from when we go out and look at kind of a kind of a investment in kind of a private equity, we would look at a project from all these angles in terms of physical and transition risks. Difficult to price now, but there are some sort of carbon pricing around that you can make reference to. Certainly, the COVID-19 has slowed the progress in terms of the pricing. But I'm sure as regulation starts to come, the pricing and that kind of data and stats will be more acute, and people can work better with that, and that will shock people, I think, in years to come. In our region, as you know, that China has mentioned that they go net zero by 2060. Japan just said recently 2050. So all that will culminate into regulations, and then the carbon pricing will start to take take traction, I guess. So I guess we will look at it more of a holistic way. We can't pinpoint a very very sharp and very accurate way of using the stats to price our risk properly.
I appreciate that a whole lot. Chris, I'm going to ask that you jump in here. There's, of course, a subset of very long-term global and well-resourced investors who can manage this complexity in a qualitative scenario planning sort of way. But then there's also a cohort around the world that really needs this data to flow into their more usual models in order to make it work. I'm curious your perspective on the statistical question that we've just asked, and I'll also put a spin on it as well. Is a carbon price needed to make risk statistics work for climate change?
It's not. And the bulk of the work that we've been doing with Woodwell is on the physical risks, so almost unrelated in a way from the carbon price. The carbon price is needed to affect the transition to a lower carbon economy. But the risks of heat, drought, wildfire, water scarcity, flood, hurricane, air quality, sea level rise all still exist with or without carbon price. These things, again, are baked in the cake, unfortunately, because of the prior emissions. So, my view on the risk statistics is, one of the major sins of the financial markets is it's really a pattern recognition industry. If you think about factors like quality, momentum, value, we've got 100 years of history, and everyone imagines that history will persist over some time. We've studied these factors. They have extra premium attached to them. There's no such thing for climate change. We don't have the history in terms of what the future is going to be. We don't have enough years of this new change. We have about 20 plus years of this changing climate, not 100. And the next 50 to 100 are going to be far different than the last 100. So I think classically, Wall Street quants will be trying to sort through data and come up with some relationship, but it's going to be hugely spurious because there's not enough climate data. So in exchange for that, what I recommend is that we use forward-looking projections essentially for the first time in our industry without a back history to prove them. The back history of proof is that the science has been accurate. It's not back history of proof that the financial markets can make trades off of it. So, I think the exchange for that is use projections. And then I think to Kim's point, where you can go with that in the absence of having a measure is engagement. And so you can talk to company management teams and make sure that they are prepared, that they have the right resilience in place, even if you can't put a risk factor on that.
Right. Let me ask one sidebar question, and then Deborah, I'm going to come to you on that issue of pattern recognition versus being more proactive. But Chris, we've now heard allusions throughout the conversation, partnership that you and Untitled Teachers and perhaps others have with Woodwell. Can you just share some facts about what that collaboration is and how it's helping you?
Sure. So we started this about 2 years back. CalPERS, Ontario Teachers Pension, and a third large asset owner have joined us. We study these topics together. We have an annual research agenda. The first research agenda was the 7 key risks that I mentioned earlier. So heat, drought, wildfire, hurricanes, flood, water scarcity, and air quality. And essentially what we did is study those. Woodwell helped us project them out for the next 30 years and then put them on geospatial maps so we can see those risks at any location. And then to Deborah's example earlier, plot a security on that map and see what its flood risk or drought risk or wildfire risk may be. And the real epiphany there was to make this a visualization exercise, again, to project in the future and not look back in the past. If we turn this into Excel rows and columns, then we're back and trying to look through historical patterns. But visualizing maps really gives you a new part of your brain to think about the future. So that's what we've been doing. And then, you know, I'll just end with, we've inverted a couple of things. One is the science community really focuses on the year 2100 in lots of their studies, and you lose investors very quickly when you talk about 2100. So we have tried to do a lot of translation, for lack of a better word, between the science community and the finance community. One of those translation points is we don't need to talk about 2100. The next 3 decades have enough pain in them for financial markets that we can focus on 30 years and under. So we do that. And then the second thing we invert is you don't come out and say the sky is falling, all securities, all industries treated equal, they're all going to have massive climate damage. It's not true. Some securities, some industries have lots of risk, others have very little risk. And you need to be intellectually honest about that. And you can get people's attention much more focused when you don't say it's an entire problem to their fund.
Sure. Thank you for that. I'll remind our audience that we do take questions either through the chat or by email to Bryn, BRYN.Costello, COSTELLO at FCLTGlobal.org. Deborah, I'm going to lean on a little bit of the conversation that you and I had before the event began about the difference between being reactive and proactive. This just made, I think, a very interesting point about the history of the profession being one of pattern recognition, but pattern recognition not being sufficient now. I particularly like an owner's perspective on that. What do your beneficiaries and sponsors expect of you between reacting to this data, recognizing patterns versus being proactive? And how is this collaboration with Wellington, CalPERS, Woodwell helping you fulfill that?
Yeah, I mean, you know, we're a pension plan, so we have liabilities that expand out to 70 years, right? So a teacher that enters the plan today, they'll work for 30 years. Actually, they work for 26 on average, and they'll be retired for over 30 years, right? So that's a very long time horizon. So when we think about, you know, our members' needs, you know, we really need to think about being able to pay their pensions over that entire time frame through their retirement. And, you know, being a perpetual pension plan, every day, every year, we're getting new members, right? So it just continually pushes out our time horizon. And I think, you know, being proactive really means getting ahead of the curve for us, right? So we have to react to short-term risks. Obviously, we need to make sure that we can meet returns today. But I think, you know, there's an aspect where we have to make sure that the assets that we invest in are sustainable over the long term, because that's what's also going to help pay pensions in that long horizon. And that's where I think, you know, at Teachers, we do look at historical data when we think about, you know, risks and return trade-offs and things like that. But I think, you know, we have long-term assets, and the teams and, you know, us are very focused on what are the long-term implications. We have to price that asset today, and we need to know that we're going to get a 30-year cash flow from that asset. So I think there's a natural inclination to, you know, realize that we can't rely on past history, and we need to sort of think about what are the future implications. And, you know, an example of some of the work that we do with Wellington and Woodwell is really on maybe some of our agricultural assets. And I talked a little bit about that. We were looking at some agricultural assets, and, you know, they're impacted by drought, they're impacted by flooding, they're going to be impacted by heat. And we need to understand, you know, what did the future expectations for increase or extreme heat days or flooding, how does that impact the asset? How does that impact the cash flows that we're going to get from the assets in, you know, 5, 10, 20 years out? And so with the work that we do with Woodwell, we're actually able to, number one, you know, map out all of our agricultural locations against, you know, flood maps for, you know, the next 10 years, what the flood map looks like in 20 years, and understand how vulnerable our assets are to that. we can look at the projections for the number of extreme heat days and think, okay, there may be periods of time when outdoor labor just isn't possible. And so what does that do to productivity? How does that, how do we deal with sort of the fact that in an agricultural investments, most of your labor force needs to work outside? And finally, thinking about yields, right? So if you're in ag investments, different crops will have different heat tolerances. And if you're looking at a period where you're going to hit more extreme heat days that are beyond the tolerance of the crops that you're looking at, you got to factor that into your cash flows and the productivity, the productivity of your assets going forward. So I think it's a very natural inclination for a teacher's pension plan to think that way. And having access to the Wellington and Woodwell partnership has been extremely valuable to us in being able to have that kind of analytics at our fingertips.
I appreciate that so much, Deborah. Thank you. I alluded at the beginning of our conversation to the fact that this subject was also part of the agenda at a summit that FCLTGlobal hosts. This is an event every other year in which our CEOs and CIOs gather. A question came out of that conversation in March of this year about whether existing risk models can encapsulate the types of risks that we're discussing right now, or whether, quote, separate buckets are needed. It's related to another question that I wanted to raise to the panel about the extent to which existing risk statistics can adapt for climate versus the need for new statistics. Kim, I'd like to go to you with a combination of both of those questions. Is this a traditional risk bucket that we're just beginning to measure, or is it a separate one? And how, or to what extent can our existing statistics adapt?
It's a tricky one, I think. I think it's very, very difficult to adapt the existing statistics and blend in the climate risk. As I think all the other speakers mentioned, that climate risks affects certain sectors, certain industries, certain companies, and the reaction function actually has a big impact on the net return, the net outcome. So it's a multitude of risks. We are trying to engage with a company, a consulting company, to see how or whether we are able to merge it in our kind of asset allocation framework, which means that can that adapt to our traditional kind of measurements that come up with a nice volatility, risk return, Sharpe ratio, and all that kind of stuff. I think our conclusion is it's very, very difficult. We can come up with some rough estimate. We can come up with some types of assets that are more susceptible. But I think when we start drilling down, I think a lot of idiosyncrasies around the kind of assets and behaviors and so forth, that you can't use a broad brush and say, look, this is it. We apply this using this set of data, and out comes a nice round number. And does it meet your investment threshold, return threshold? Yes or no? I mean, it's not quite simple as that. So I think it's if you say you need a separate bucket, yes. If you're targeting a certain industry, I guess a very kind of carbon heavy industry, yes, you may have a bucket that you can calculate kind of emissions and potential ramifications when regulations come in and carbon emission tax comes in and so forth. That is a little bit more better to manage. But I guess if you try and blend in with your traditional set of assets and using your kind of formulation and your calculation, I think it sort of just breaks down. I find it very, very difficult. I think as I think Chris mentioned that, you know, you do need to drill down on individuals kind of investments. If you do have it chunky, a chunky investments that you can, a discrete one, you see how it impacts the investments using perhaps scenario analysis, how the company is managing those risks. Are they taking it holistically? Are they doing kind of stress testing and that kind of stuff that you try and approach the risk in that manner rather than having a nice number with stats to help you and come up with a decision. I think it's we're not quite there yet.
Sure. Thank you for that. I have a follow-up I want to ask, but let me first, Chris and Deborah, give a chance just to respond. I think Kim put a lot of rich content on the table. Did that raise any ideas in your mind?
Go ahead, Deb. I'll go next.
Sure. I mean, I think Chris is absolutely right. It's really difficult. And I think the added nuance is that, and maybe this is a downfall of most risk modeling, is really that, you know, it's nonlinear, right? And we have a very difficult time dealing with nonlinear situations in our traditional modeling. And this is particularly important in terms of thinking about climate risk, because you know, and Chris will talk to this a lot of times, is that there's going to be at some point when we hit tipping points, both on physical climate risks, where it will just spiral out of control. But there's also breaking points for the system, right? And many of the assets that we have today look resilient, maybe over a short time horizon, but once you get past a certain breaking point, they also, well, it falls apart. So I mean, I think it's a big challenge that we have, and I think what Chris was saying, Kim was saying with regards to scenario analysis is really one way that we can sort of adapt our risk management processes to try to capture some of these non-linearities.
Matt, I'll be quick on this one because I think my prior response is key to this whole issue on the pattern recognition. But much like real estate, we found in climate that location is really the key. And if you start with location, that brings you closer to the company level and further away from macro, top down, this one risk factor solves all. Every company's different, every location is different, even in the same country, like in the US and China and India, you have massive different climates across the same country. So company level has been much more insightful for us than macro level. I would say if you were trying to think about risk factors, they should revolve around location and duration. Location and duration. Again, fixed locations have the most risk and the longest maturity has the most risk. So coming up with new risk factors around those two would make sense. We have created something called a climate adjusted yield, which is a new measure. And to Deborah's point on the tail risks, we actually stochastically shock a location with a 10,000 run simulation, see how many times an event might hit that spot, and then assume that that bond, say it's attached to infrastructure, would be impaired in some way that resulted in a credit downgrade. We then adjust the yield for what it should be had you had a different credit rating. That's something where I think we're taking on a forward-looking view with traditional understanding of credit ratings and downgrades, but then assuming that there's future damage to one of these sites. And the last thing I would say
Thank you
is,
for that.
sorry,
go ahead.
Matt.
Yep.
Nope.
No, please.
The last thing I would say is, you know, there's going to be lots of mistakes made with standardizing reports, and I'm not picking on any vendors, but just coming up with one score and saying, you know, India has a climate score of X, you can immediately defease that argument by picking any company who is an exporter or lives in the ether, software company, has no customers in the country, has no business in the country, but then you've given that company a country score from where it's domiciled, right? That's just one quick example of how you blow up that model.
Thank you for that. Chris, you put something onto the table that somebody in our audience would like to follow up on, and that is getting down to the micro, getting down to the corporate level. We have a question from the room about whether the panelists can comment on the current state of climate risk disclosures from companies that are aligned with the TCFD disclosure framework. So since you made that point first, let me give you the opportunity to respond to that question. And then Deborah, I'll go to you, and Kim to you.
The current state of climate disclosure is weak. I was fortunate enough to serve on the US CFTC climate committee that published a report a couple of months back. It's well worth reading. There's an entire chapter on climate disclosure. We also published something called the PROC, Physical Risk of Climate Change, which is a framework to help companies better disclose their climate risk, because we found the disclosures severely lacking. Our experience from that is through reading CDP disclosures and 10Ks. We've now done this on about 1,500 stocks, specifically on climate change. Very few of them stand out as informative, fully transparent, detailed, to Kim's point, providing scenario analysis. Very few companies are doing that. I'm not saying it's because they don't want to do it. I think it's a lot of times they don't have the expertise, they haven't hired the right firms, et cetera. One of the points that we've made consistently in these papers is, and I'll just end on this, corporations should think about climate change as an enterprise risk. So we have cybersecurity, we have compliance, we have all of these risks that companies have to hire up for. Climate shouldn't be any different. And if you hire up for it as an enterprise risk, you will then assess it, you will disclose it, and then in theory, you will do something about it, be that build up your resilience, CapEx, more insurance, et cetera.
Deborah, I'll go to you next with your view on that question, but there's a follow-up as well that we'll weave in, and that is whether making the disclosure mandatory would improve the quality. Do you have a view on that?
Those are two very different things. There's disclosure and then there's quality. And I don't know that they are aligned right now. And I would agree with Chris that most of the disclosures are not very good. I would probably say there has been very good uptake on the TCFD recommendations, but at the end of the day, looking at their last status report, I think it was like 790 companies that have agreed to adopt TCFD reporting. If you think about the number of companies there are in the world, this statistic is really not very good. And I think the second aspect of that is the quality of these disclosures. And I think, you know, the TCFD provides a really good framework for how companies should disclose their climate-related risks. You know, I think it's important that, you know, you look at the governance, you look at how it's built into risk management and strategy, and then it really comes down to the metrics. And I think that was a key part of the TCFD recommendation, is that what gets measured gets managed. And I think, you know, some of the qualitative aspects of the TCFD reporting, you know, they're very high level, they're non-specific. You know, you could probably take one company's TCFD report and throw another company's name on it, and you probably wouldn't know the difference. So for us, I think it really comes down to number one, metrics, and seeing those trends in those metrics, and are they improving, are they not improving, how do they compare to their peers? And I think that's where we need to get to. I mean, on the question of mandatory, I think it helps, right? Like, I think, you know, unless you make it mandatory, companies will not start reporting, they will not start measuring the metrics that they need to. So I think mandatory disclosure is a good step forward, but it will not necessarily get us the quality that we need yet, but it'll get us, it's a good step forward.
Kim, what are your views?
I think both Chris and Deborah said, you know, perfectly well, the problems. I think I fully agree with what's been said. The quality is not quite there. Both quality and quantity is not. Using TCFD framework, yes, it's a good framework, but a lot of it is high level. You get the different pillars. You got to discuss about governance, strategy, and risk management. As I fully agree with what Deborah said, you know, if you put a different name, different company on the report, you know, you can still use it, you know. So it's a tough one. I think the kind of objective and the kind of driver is right. How useful it is, and it varies. Right now, I don't think it's that useful. But I think the more people start adopting it, and the more people start measuring it, as Deborah said, if you don't measure, you can't manage. The more data comes out, then you'll be able to make better sense of your exposures to various companies. But if data out there is still very sparse and lacking, then your own quality, your own data will lose its value too. So try as we may, I think it has to be a everyone's effort, group effort to move in the right direction. We know it's not perfect. There's still a lot of understanding to be made to understand the mechanism and to get the right data and to apply it properly. I think somehow we have to make a start, but right now we don't see it being that useful. Being mandatory, I think, will help eventually.
Sure, thank you.
Can I just add a point on that too?
Please.
At the end of the day, we're talking about data, and if there's not enough data and it's too sparse, the data doesn't get used by analysts either, right? They can't deal with one data point from one company and have nothing for the other companies, right? So to the extent that, there is full sets of data across a sector, actually also encourages analysts and investors to be able to now use these data in their models. And I think that's a point that people don't usually kind of think about, but without a complete set, it's not going to get into your modeling.
Absolutely. I appreciate you reminding us of that. It's a vital point, particularly for institutions of the scale the three of you represent. I like the conversation now down into the real practice within your organizations. We've heard time and again from our members and others that they really appreciate chances to learn from how you deal with issues like this. So Deborah, I'll stay with you and then go to Kim and then to Chris. Are there things that investors can learn and implement from your experience managing climate-related risk? Anything that you would share with a group about what you've learned within Ontario Teachers Pension Plan?
Yeah, I think our big learning is that you kind of need a top-down, bottom-up approach, right? And I think you need senior management to set the tone and say, you know what, climate change is an important issue for the plan. It's important for us to manage both physical and transition risks, and it's important for us to think about how our companies and our portfolios are contributing to a orderly transition to a low-carbon economy. Because I think at the ground level, from the bottom-up perspective, back to Chris's point, is that many of these risks can't be really modeled at the macro level or dealt with at the macro level. And it really needs to be a case-by-case assessment of this particular company in this particular locations, and the context in which the company operates really makes a difference when you're trying to embed sort of physical and transition risks into the assessment. And having the top-down push to do this is needed as well. And then the second part of that is really just to make sure that they have the resources and tools and information that they need to begin embedding this into their integration processes. And that's where my team comes in, because we are a dedicated team that can actually go out and help provide subject matter expertise, bring in resources like Wellington and Woodwell to the investment teams to help them with that.
I'd like to follow up very quickly before we go to Kim. At the beginning of your answer, Deborah, you alluded to how important it is to communicate in a long-term way about these risks. And this is a theme that's come up in our research over and over and over again. It's not just how you manage it at the bottom, but also how you're then able to relate it to board, sponsors, stakeholders, and the like. Is there anything that you can add about how we communicate these risks that will allow us to have a longer term focus?
I mean, I think it's just communicating those risks and the long-term nature of it. I think maybe a lot of times we focus on, how did we do this year and what happened this year? And we focus less time in our communications on what are the things that could happen in 5 or 10 years, right? So a lot of the conversations,
Sure.
whether it's in corporate reporting or others, it is really focused on let's look in the rear view mirror and see what we can learn from that, right? I mean, it's challenging, obviously, as a company or as a pension plan, talking about forward-looking information, but that really needs to be part of the communication, at least internally with your senior management and the board, right? You need to have those forward-looking discussions.
Thank you for that. Kim, I'm sure our audience would also love to learn what they can draw from HKMA's experience.
I think from looking at our portfolio, a lot of our assets are managed by external managers. So, even though we are able to assess projects, those are more for the private assets individually, but a vast majority of our assets are actually managed externally. So going by what Deborah said earlier, it has to be toned from the top. Our own organization that they say, look, you have to look at climate risk. This is the subject going forward, and it will impact investment returns. Having that armed with that kind of mission, I think we go out and assess our managers and see whether they take climate risk seriously in their portfolio. Their boards, their management, are they saying singing the same tune when they do the investment processes? Are they factoring in, as Chris said, if it's real assets on the kind of particular area and particular kind of subsector and so forth, are they looking at climate risks? If you drill down more finer, let's say risk of flooding, risk of severe weather and so forth, it affects the company that you're investing in. But I think, when you start drilling down, you have to think about what are the suppliers. Are your suppliers also in the high risk areas? And if they are disrupted, the company that you're investing in, the production has to stop. So I think, it's a very intricate matter. As I said earlier, it's non-linear. You have to drill down and really ask the manager, says, are you looking at these risks? Not just the company itself, but the whole ecosystem, the things that they rely on, the suppliers, the customers. Are they, are you able to deliver your goods, your products to your customers, and that kind of stuff. So I think we are stepping up our efforts in our discussion with our managers on these issues. When we invest directly on projects, we ask the same question during our due diligence process, that are these kind of events, are these risks being looked after? Have they considered it? Are there any mitigating factors that they can do when this risk arise? So all these are part and parcel of our thinking and our kind of assessment and drill down before we put our money. And for those like listed equities, we have to get data and numbers on the rear view mirror in terms of the carbon content in the portfolio and so forth. That's a starting point, and see how they are managing those risks.
Thank you. Chris, I'll go to you, and I'll also broaden the question out a little bit. It'd be wonderful to hear what the audience can learn from Wellington's experience. Also, any reflections that you may have heard on Kim and Deborah's points. And then I particularly saw you nodding your head as Deborah was talking about communication. And I'd be curious if you have anything to add to that.
Sure. Communication is key, as we talked about before. Translation is the key word. You got two industries or, levels of expertise that really haven't intersected previously, finance and climate science. So, you sat in the cockpit of an airplane, you wouldn't know what the pilots were saying. It's the same thing. Very smart people, nobody knows what each other's saying. So we try to translate. We ask very simple questions. We ask them over and over again until we can understand it, put it in our own language, and move forward. So I'll give you a couple of examples of what we've learned internally and how this might relate to the audience. So number one is you have to go out and find the expertise. We did not have it internally. Again, this is a science field. We are not scientists, so we went out and hired the expertise. You have to do that because the assumptions in climate change are everything. There's nothing else. It's all about the assumptions, and the experts can help you make the right assumptions. Number two would be make it practical and tangible. Climate change can seem ethereal and end of the world and too hard to fathom, and that's not useful. So, for investment process, as an example, we focus on location and duration. These are practical things to think about. Every company has locations. Every company has some maturity, possibly to their fixed income or to a life expectancy of a plant or infrastructure or agriculture, as Deborah mentioned. Third thing is we have focused on disclosure and then aligning that with the projections. So the disclosure is weak, but it is a starting point. And so we look at companies that have disclosed climate risks. We go and find their locations, and then we map them. We call these CPRs, climate portfolio reviews. We've done dozens of Wellington strategies covering, as I noted, about 1,500 stocks. So now you're at the stock level, highlighting what the climate risk might be at their locations. And the last 2 points would be focus on materiality. Again, not all companies are created equal in terms of climate risk. And even when there is a climate event, it may not be material. So one of my early lessons was looking at a number of pharmaceutical stocks that were hit in the Puerto Rico hurricane, where supply was massively disrupted, and never mind, of course, the human tragedy, which was terrible. And so I highlighted one company that lost about 100 million in inventory to an investor, and I said, hey, this is a big number. And he goes, yeah, big number on a 30 billion base, right? They do 30 billion a year in revenue. So yes, 100 million is a big number. On a 30 billion revenue base, it is not a big number. And so for that investor, this was not a material issue. Like, he's aware of it, but it doesn't mean that he needs them to move out of Puerto Rico or that it, crushed their long-term earnings forecast. And then the last point would be, the term climate is just totally conducive to always focus on risk. And that is clear. There is a lot of risk, but there is also opportunity because there's going to be a lot of capital spent. And if you read the Biden plan, the word adaptation is now used from, a major leader and all of his advisors in his plan. And adaptation has not really been out there as a term before. It is in the CFTC report, but adaptation is where you will see massive capital spent because society is going to have to adapt to these risks. Then there are companies attached to that spend. So in presenting both the risks and the adaptation opportunities, you can help investors think about both sides, not just what to avoid, but also where money might be spent.
Thank you for that. I want to alert our audience that we are nearing the end of our time, so please do submit any remaining questions that you may have either via the chat function or to bren.costello@fcltglobal.org. Chris, you couldn't have given me a better transition to my last set of questions if you'd tried. We've focused on risk management today, but of course that is not going to be the panacea for climate change and its relationship with investing. So I'm going to stay with you for 1 minute and then go around the circle as it appears on my screen next to Deborah and then to Kim. I'd like for you to say a little bit more about the opportunity element of this and also the extent to which we should try to address this in the risk function versus in other functions. So can you just expand on that idea and broaden out a little bit, please?
Sure. So maybe just a couple of definitions again: transition risk and mitigation on one side, physical risk and adaptation on the other side. There's been lots of capital spent on transition risk and mitigation. It's needed. It's the space of renewables and battery technology and lowering our emission footprint, all sorely needed. Less focus has been paid on adaptation. This is how are the cities and consumers and houses going to adapt? How are people going to adapt to heat and drought and floods and hurricanes and wildfires? Things like generators and dredging and air conditioning and resistant glass for your hurricane windows. These are all resilience plays that are going to have to ramp up. They've been noted in the Biden plan. They've been noted in other places. I think they're massively undercapitalized. Again, because Wall Street's been backward looking. The future is going to be a lot worse on these events, and the need for resilience is going to increase.
Thank you. Deborah, I'll go to you for the last word, and then Kim, you will bring us to conclusion. Oh, I believe you're on mute, Deborah.
Sorry about that. You know, to Chris's point, I think the opportunity side is the key to climate change, or solving climate change or mitigating climate change. And I agree with Chris that it does take both sides. You need to look at mitigation as well as adaptation. I think a lot of the focus has been on mitigation, and certainly at the pension plan, it's been focused on mitigation because we know that in order to transition to a low carbon economy, you need to invest in the infrastructure and technology that is needed to support a net zero economy. And for us, we have been looking at quite a lot of you know, investments and opportunities in that space because we see it as a really huge area of growth, particularly as you have, you know, 120 countries, over 1,000 companies and investors committing to net zero by 2050. Most of them with, you know, 50% reduction targets by 2030. I mean, I think we can get the emission reduction targets of 50%. The last piece is going to take the investment dollars in the technology and infrastructure that is needed to really make this mainstream. I think the adaptation is hugely important. I mean, you know, there's a little bit of, you know, we feel like it's a bit of a defeatist, you know, like, oh, you know, we're doomed. Like we have to start protecting ourselves. But, you know, we have to get over that and realize that that's a big area. And I think we do invest in adaptation, particularly within our own companies, right? So, you know, really part of the value creation process. If you're thinking about having a container terminal by the coastline and thinking about what are the investments that you need to make within those assets to make them more resilient to the impact of, you know, extreme hurricanes and flooding. So it's a critical part of the equation. And I think, yeah, we need to focus a lot more on that.
Thank you. Kim, the last word is yours.
Yes, certainly climate change has already become a sufficiently large factor to influence, you know, long-term investors' behavior. You know, long-term investors like us, and Deborah, and so forth. So, you know, you're already seeing capital flows are moving in that direction. You know, there are a lot of initiatives, a lot of products that are kind of considered low carbon investments. You know, we certainly look at renewables, both wind and solar. I think as in most investment decisions and in portfolio managers, you know, you want to be in the first mover, I guess. You know that you know, capital will flow to areas where I think Chris mentioned, you know, adaptation and mitigation and so forth. You know, you have a lot of, you know, products in there, both of those issues, the EVs, renewable energies, and all that. We're seeing a lot of companies pitching to us a lot of investment ideas, both in listed equities and also unlisted. Just on the listed equities, there are very, very clever ways of reducing, kind of a carbon decarbonization by tweaking your portfolio, tilting, give them some kind of tracking error. You can move along that way, or for the more advanced ones, you can actually go for best-in-class kind of investments. And as I said earlier, if you are there, the first mover, you are there, you have the advantage, and you see the kind of the group will move along that way. So I think it's safe to say that we are seeing the trend. Every other day we see people knocking on a door, giving us ideas on this, and we certainly find good ideas, certainly find ideas which have a track record and have proven that worked. We are looking at those mandates, and I think that will help the industry, that will help more products to come out, and money to go in the right direction, I guess.
Thank you. I appreciate those insights. I'm going to go ahead and bring us to conclusion again by thanking all of our panelists, Chris Gulgazian from Wellington, Deborah Ng from Ontario Teachers Pension Plan, and Kim Chong from the Hong Kong Monetary Authority. Also, a special thanks to my colleague, Bryn Costello. I mentioned at the beginning that FCLT Global exists to move money in long-term directions. If you see opportunities to take action on the basis of the conversation today, please do reach out to me at matthew.leatherman@fcltglobal.org. We'll be glad to have those conversations. You can also see our research on the subject of long-term risk management at fcltglobal.org/resources. The webinar will take a break for the holidays in December, but we will return in January with a session on time diversification. Is it patience or complacency? Featuring David Turkington from State Street Associates. I'm going to conclude today by asking Bryn to share a cartoon that Deborah initially called to our attention that I think provides a little bit of context for where we stand. COVID is in front of us, recession is as well, but climate change is indeed the secular trend that Chris mentioned. Thanks you all for being part of the webinar today, and we look forward to seeing you in January.